explain to you how to answer on MFRS 110. For FAR460, this topic will not be tested in one question. Instead, it will be asked in the published account under the additional information. So it's quite simple. Alright, so first case, Vintage RT Berhad operates in the manufacture of guitars and prepare its financial statement to 31st December each year. A profit before tax for the company is 12.5 million as shown in the SOPL for the year ended 31st December 13. So this company close account on 31st December 13. Right? So when you do the MFRS 110, you need to know when is the financial year date and when the financial statement is authorized for issue, because even after the reporting date fall after the year end and before the date it is authorized for issue. Okay, so to make it simple, immediately before the financial statement were authorized for issue, the following event took place. So dia dah bagi tahu lah, this event is actually in between financial year and date it is authorized for issue. So the first case, the company received a communication from a customer, Redspec, that they have been placed into liquidation and was not able to pay. So this is your account receivable where he goes into bankruptcy, so meaning they cannot pay the debts. So this should be an adjusting event because whatever that you have reported in your SOP is not correct, because you will not get this money. So this is adjusting event. So the adjusting event will the journal entry will be, you should credit your account receivable to reduce the amount of debts, and you should debit allowance for impairment of trade receivable by 65,000. Okay. Number 2, a batch of product was carried at 150,000 in the SOP but sold during January 14 for a total of 100,000. Remember, the account closed on December 13. Okay, so on that date, on the 31st December 13, you report that your inventory is 150,000. But after you close your account, you sell the inventory in January, and the total is 100,000, which is much lower than what you have reported in your SOP. Alright, so the reason for the low price was damage caused by a flood which took place in the warehouse in early September 13. During the year, there was a flood. Okay, so this is of course an adjusting event because in accounting, when you report the inventory, it should be at the lower of cost and net realizable value. Net realizable value is the amount that you can get when you sell the inventory. So in this case, what happened is you report in your SOP at 150,000, but when you realize the NRV is actually 100,000 only. So based on the accounting convention, you should report it at the lower. So between 150 and 100, it should be 100, but you have reported 150. It means that your closing inventory is overstated by 50,000. So the effect is when your closing is overstated and this closing inventory is affecting your COGS. Alright, in COGS you less the closing inventory, so your COGS become understated. So how do you correct this? So you have to debit your COGS and you have to credit closing inventory. Okay, debit COGS because it is understated and you have to add it back. You credit closing inventory because your closing inventory is overstated, so you have to reduce that closing inventory, which you report in your SOP under current asset. Okay, the third one, an insurance claim by Vintage RT Berhad for 121,000 was agreed on 1st February 14 relating to the flood as a compensation. So the flood has happened in September 13. Only that you get the insurance claim after you close your account. So of course this is event after reporting period, and this is an adjusting event because the flood has happened during the year. So the adjustment would be debit insurance receivable because you have not received the money yet. If you have received the money, of course you will debit bank, but because you have not received the money, so you will debit insurance receivable. So this one will become under current asset lah. Okay, and credit SOPL because this is considered as income to you. On 6 March 14, Vintage entered into a guarantee agreement with PTL Bank to guarantee payment obligation of its subsidiary. Aqua, the loan in the amount of 200,000 was used to acquire a new plant. By doing so, Vintage agrees to repay the loan should Aqua be unable to generate enough cash to repay the debt. So the flood happened does not affect the going concern status of the company. So this is a non-adjusting event. Okay, this flood is actually a general, the general statement for the whole case of the company. It does not relate to this guarantee agreement. So for this guarantee agreement, this is a non-adjusting event. So when it is a non-adjusting event, there will be no journal entries because all this take place after you close the account. So it will not be considered as adjusting event. Alright, the condition does not exist during the year. Okay, alright. Another example, identify the nature of the following event. Cuci Berhad, a developer and manufacturer of household and commercial cleaning product, prepares financial statement to 31 December 14. So on 2nd March, 200,000 was paid to Mr. Hang as compensation for his removal as finance director. So this is considered as adjusting event. Okay, so when you pay, of course you credit bank, and this payment is considered as your expenses, so you will debit SOPL compensation expenses. Okay, assuming that this event happened before the financial statement is issued, is authorized for issue. Okay, Mr. Hang had been dismissed by a majority vote at board meeting in February 15 with a compensation payment of 150,000. The reason for his dismissal were in relation to professional misconduct. The financial statement of Cuci were approved by Board of Directors on 1st April. So this is adjusting event. So again, it is expenses to the company because the company need to pay for the compensation. So it will debit SOPL compensation expenses and credit bank. Okay, last one. Okay, FAR Berhad has an investment worth 1.5 million in its financial statement on the 1st December 14. On 15 January, which is after you close the account, the investment has fallen significantly in value due to the continuing recession. So the financial statement will authorize for issue on 22nd February. So this is of course event after reporting date, but this is a non-adjusting event because the condition of the drop in the market value does not happen. The condition does not happen during the year. So it is something that is out of control. Alright. So whatever you have reported in your SYP for that investment is no need. You don't have to adjust for that investment. Alright. So this is non-adjusting event. So no journal entries. Okay. I think that's all. MFRS 110 is quite simple because you just need to do the adjustment in your publish. Alright, thank you very much.